Dylan buys a rental property. Cole puts the same money into index funds. Both of them think they made the smarter move. Truth is, one of them underestimated how much time this would take, and the other underestimated how powerful compounding really is. And when you actually run the numbers over 20 years, the difference isn't what most people expect. Let's keep this fair. Dylan and Cole both have $50,000 saved. They both make $55,000 a year, same age, same city, same starting point. The only difference is what they do with that money. Dylan uses his $50,000 as a 20% down payment on a $250,000 rental property, just a basic 3-bedroom house in a decent neighborhood. He locks in a 30-year mortgage at 7%. His monthly payment comes out to about $1,330. He finds a tenant willing to pay $1,800 a month. On paper, that's $470 in monthly profit. Looks like a great deal. Dylan feels like he just made a power move. Cole takes that same $50,000 and puts it into a total stock market index fund. No leverage, no tenants, no headaches. He sets up an automatic contribution of $300 a month and then pretty much forgets about it. When people ask what he's investing in, he just says, index funds. Nobody's impressed. The conversation moves on. On day one, Dylan looks like he's winning. He's got a house, a tenant, and something real he can point to. Cole just has a number on a screen. For the first few years, Dylan feels like a genius. Rent hits his account every month. He drives by the property and thinks, I own that. He's getting tax write-offs, building equity, and watching home prices slowly climb. Everything about it feels solid and smart. Cole logs into his account once in a while. Sometimes it's up, sometimes it's down. Year 1, maybe it grows to around $55,000. Year 2, maybe $60,000 plus. Nothing exciting, no story to tell, just quiet growth. Now, fast forward 3 years. Dylan has collected around $64,800 in rent. His mortgage payments total about $47,880. On paper, that leaves roughly $16,900 in cash flow. Sounds great until real life kicks in. Property taxes run about $3,000 a year. Insurance adds another $1,500. He replaces a water heater for $1,200. Fixes a roof issue for a couple thousand. One tenant moves out. And now he's got a month of vacancy, lost rent, cleaning costs, and time spent finding someone new. He's handling everything himself. Late-night calls, weekend showings, repair coordination. When you subtract all the real costs, his actual profit over those 3 years might only be a few $1,000s. Not even close to what it looked like on paper. Meanwhile, Cole has invested his original $50,000 plus about $10,800 in monthly contributions. At around a 10% average return, his portfolio is sitting somewhere near $75,000 plus. He didn't take a single call, didn't fix anything, didn't deal with anyone. But here's where Dylan still has an edge. Leverage. His $250,000 property might now be worth around $270,000 to $280,000. His equity has grown, partly from appreciation and partly from paying down the loan. That's real wealth, built using the bank's money. The rent number is what everyone talks about. That $1,800 check sounds great, but what people don't talk about is everything that comes out of it. Vacancies, maintenance, repairs, big-ticket replacements like roofs or HVAC systems, and the constant time commitment. By year 5, reality sets in. Dylan has gone through multiple tenants, maybe dealt with a plumbing issue, maybe a big repair bill. Rent has increased a bit, but so have taxes and insurance. His real return, after everything, is decent, but not insane. Definitely not the easy passive income he imagined. Cole? still doing nothing. His portfolio keeps growing. Compounding starts to pick up speed. At some point, his gains each year start becoming bigger than what he's contributing. By year 10, things get interesting. Dylan's property might be worth $330,000 to $350,000. His remaining loan is much lower, so his equity looks strong. Cole's portfolio, with consistent investing and market growth, is in a similar range. At this point, they're surprisingly close in net worth. But the path looks completely different. Dylan put in time, dealt with stress, and took on debt. Cole stayed hands-off, stayed diversified, and let time do the work. Now, fast forward to year 20. Dylan's property might be worth $450,000 to $500,000, and the mortgage is nearly or fully paid off. He's built solid equity. Over time, he's also made money from rent, but after years of expenses, repairs, and turnover, the net profit isn't as huge as people assume. Cole's portfolio, on the other hand, has grown through consistent investing and compounding to somewhere in that same ballpark, or even higher depending on contributions. They both end up in a similar place financially, but how they got there is completely different. Dylan worked for it, tenants, repairs, and risk tied to one property. Cole dealt with market ups and downs, but had liquidity and freedom the entire time. And here's the twist. If Cole had just increased his monthly investment a little more, the gap could get even bigger over time. That's the multiplier effect of compounding. At the same time, stocks aren't perfect. Market crashes happen. Seeing your portfolio drop 30% isn't easy. And unlike real estate, there's no steady monthly rent check. Real estate isn't bad. Stocks aren't perfect. The real mistake is choosing one without understanding the full picture. Both paths can work. Both have trade-offs. The only thing that actually matters is whether you've accounted for everything: money, time, stress, and risk. Because the answer that includes everything is the only one that actually counts. And if this broke your perspective even a little, hit that like button so more people actually see the real math behind money. Subscribe for more no BS breakdowns like this, and drop a comment. Are you team real estate or team stocks?